a lot of people want to know, is there anything I can do when they're in a higher tax bracket? I call it the Secret Backdoor Roth IRA because a lot of people don't know about it. Can you kind of walk us through that concept?
Yes, the backdoor Roth IRA it's a loophole basically in the tax system that allows us to do this.
Hi, I'm Annette Bau, host of the Wealth Inside and Out podcast and founder of the Millionaire Insider. My mission is to help you simplify the money game so you can create a financially secure and fulfilled life without having to have a PhD or spend countless hours on your finances. You're going to learn how to think like a millionaire, stop worrying about money and wondering if your financial house is truly in order, and instead spend your time doing what you love. With over 3 decades advising 7, 8, and even 9-figure millionaires, and now joining that elite group, I'm in a unique position to help you make the best financial choices so you can create a secure financial future and retirement you love. This is the Wealth Inside and Out podcast. If you have not had a financial checkup, I encourage you to go to themillionaireinsider.com/FC. This is one of the next best steps you can take to secure your financial future and create a retirement you love. And today we're diving into a really fun option for retirement. And it is considered a qualified account, even though it kind of acts like a non-qualified one. But it's one that people can take advantage of if they don't qualify for a Roth. For today's show notes, you can go to themillionaireinsider.com/84. All materials and intellectual property are copywritten by themillionaireseries.com. This information is for educational purposes only. It is not intended to replace any advisor or specialist or to provide any investment, financial, tax, retirement planning, or healthcare advice. I've asked one of our financial transition advisors to join us today, Oscar Alvarez. So welcome, Oscar.
Thank you for having me.
It's great to have you. And Oscar's such a wealth of information. I love, especially on these technical topics, to have someone else give some different insights so that you're not just getting my insight, but you're really getting insight from one of my advisors that I have certified. Let's just start by, first of all, talking about kind of the big picture of qualified monies, qualified versus non-qualified. And then it's kind of confusing because even though a Roth IRA is considered qualified, it's after-tax dollars. Can you give our viewers kind of an overview of that, Oscar?
Sure. It's really two camps. Qualified money is money that you're looking at that might be in a traditional IRA. It might be in a Roth IRA. It could be a 401k, a 457, 403b plan, any of those type of accounts that are basically earmarked as retirement money. Non-qualified are maybe just like a simple brokerage account. It could be a CD. It could be a bank account, a money market at your bank. So things that are not earmarked for retirement. And that's really probably the easiest way to differentiate qualified and non-qualified.
Okay, that's very helpful. So an IRA versus a Roth, can you give some insight on that?
So a traditional IRA is money that you've put into this account, the traditional IRA account, but you put it in before taxes. So either maybe through an employer, or if you did it on your own outside the employer, you were taking tax dollars, putting it into the traditional IRA, and then you were able to get a deduction on your taxes. For most people, there's limits. If you're under 50, you could do $7,000 for 2024. If you're over 50, you could do $8,000. So you could take money out of your pocket, put it into the traditional IRA, and you get a deduction. A Roth IRA is you're taking money, once again, out of your pocket, you're putting it into a Roth IRA, but you get no deduction. However, the money grows tax-free. In the traditional IRA, when you start pulling the money out down the road after you're 59 and a half, you will have to pay taxes on it. With the Roth IRA, there's never any more taxes. It continues to grow tax-free.
As compared to being tax deferred on a traditional IRA.
Correct.
So I love that. I think one of the comments I want to do before we dive into this concept is just talk about ratios of money that's maybe after tax or personal money or a Roth, which I'm just going to categorize that kind of over here, even though it is a little different, versus qualified accounts like IRA, 401k. one of the things that I do see some people get into a problem with is where they have too much money in qualified accounts. And in fact, I can think of a couple of situations where they've got so much and they don't really have the flexibility of taking money, say, out of personal monies and paying capital gains rates, or taking less money out of qualified, which sometimes pushes them into a higher tax bracket. So can you elaborate on that?
Yes, I think, and we see this with a lot of clients, is they've been instructed all their lives, put money into your 401ks, 403bs. And so they did that. They funded them to the maximum they could. And now at the other end, at retirement, they have this huge pot of money. And whether they need it or not, that's all their retirement money. And now it's all going to be taxed, whatever the tax rates are at that point in time. It could be today or it could be 10 years from now, but they're going to get taxed on it. Whereas if you try to balance how much you put into the traditional IRA with maybe a Roth IRA, and many companies have Roth 401ks as well, if you can try to get a balance there, and I talk to my clients today, put in enough to at least get the match on a 401k, but then after that, really consider the Roth IRA or the Roth 401k, because who knows where taxes are going to go. I happen to be in the camp that believes it'll only go up in the future. So let's put more into the tax-free stuff, pay the taxes today with the idea that you won't have to worry about what the tax rates are 10, 15, 20 years from now.
Yeah.
So the ratio can be a lot of different things. It's what the comfort level of the client is and what their tax situation is.
Yeah. And I think that anyone that does not think taxes are going to go up. So, everyone's so concerned about the deficit. And just to make sure everyone's clear, the reason the deficit is so high is because tax rates are so low. So people think, oh, it's great to get a tax break. And believe me, I get it. I mean, I'm not complaining about that, but it's not solving the problem of our deficit. And at some point, somebody's got to pay for that. Kind of like you're overdrafting your bank account and you're ignoring it and you're accumulating interest. You're like, oh, this is so great. I'm spending on all this stuff. I enjoy it.
Right.
In reality, at some point, that's got to be paid back. And unlike us that file bankruptcy, it's unlikely that our country is. Who's going to pay for it, or all of us? So we just want to be clear on that. I do want to talk one other concept before we dive into this backdoor Roth IRA, is the concept of when you have a lot of money in qualified accounts. And if you are of the belief that tax rates are going to go up, then the option of taking that IRA money that's in a traditional IRA and converting it to a Roth. Can you just walk us through that?
So that is a process also. And if you have large amounts, I do, like with my clients, I do try to talk to all of them about, let's start a conversion plan with their money. We have to now do a tax analysis. However, I think it's important for people, especially if they're not needing that money right now, start some sort of a conversion process. And what the conversion is taking money out of your traditional IRA and moving it to a Roth IRA. The key element there is that you have to pay taxes on this money. So it would be preferable if you had money somewhere else to pay the taxes. If you're over 59 and a half, you can pay the taxes with the conversion, and that's okay too. But once again, you just have to keep in mind, you're going to pay taxes on any amounts you convert. My thing with my clients, I do the tax analysis and work with their CPAs to make sure we don't bump them into a new tax bracket.
Yeah.
So we're always very careful about how much are we converting every year. You don't want to do it all in 1 year because you'll get killed. You won't keep as much as you hoped.
Yeah. And you need to do it like if you have a down year, you have a look at that. And I think, God, there were a couple of years, I wish we would have done that because our income was down, to where it would have made more sense. Now it's like, it's hard for me to believe that it's going to go higher. It could, but it's still, if you're in a high, you're having high income years, that may not make sense. And that's why I think it's really important that you do an analysis.
Yes.
No, so that's really good. One of the things I wanted to just comment on that I had just recently read, if you can just clarify, typically with a traditional Roth IRA, you're not required to take money out. Is that your understanding?
That's correct.
But if it's a 401k Roth, that's a different rule.
Right. Actually, that rule just changed. So that you don't even have to take it out of the 401k Roth. But
When did that
and I think
change?
that just came out last year, if I remember correctly. The rules are constantly changing. You have to keep up with them.
Well, I
But
just read this article, literally. I just read it last week and I was like, "Oh, I thought you didn't have to." So, okay. So, but these are the points here, guys. This is so important. Is that here I just read this article that was just published saying this, and now this is what it is. And so you just got to double check. And if I was advising somebody on a 401k Roth, I would be making sure and doing the research
yes,
real time, because
yes,
you just can't listen to what you get all the time because it's out of date. I mean, here somebody's telling you this and then it's that. And recently on Social Security, you have to start taking it for some people at 72, some at 73, some at 75. Those continue to change. I'd literally recorded an episode and it was like, then change. So you just got to really pay attention. It's not going to stay that number. And who knows, by the time we get done here, it could change again. But anyway, just
right.
something to be aware of.
Well, I'm pretty sure if I remember reading that correctly, I'm pretty sure I'm right that the Roth is no longer it's no longer has an RMD, required minimum distribution requirement
For the 401k.
for the 401k Roth.
Okay, perfect.
Yeah.
Okay, refresh us on you can contribute under
Right.
50.
Under 50, you can contribute 7,000 a year. If you're over 50, you can contribute 8,000 a year to either a Roth or a traditional IRA. The rule is the same for both.
Okay. And who can contribute to just a traditional Roth?
Anybody who has earned income. So for the rule there's similar rules for both. So the Roth and the traditional, you have to have earned income in order to contribute. But let me give you an example where there is one exception, and that's for a spouse. So let's say I'm the earner of the family. My wife, she's not earning anything. I can still contribute because I'm over 50. I can contribute 8,000 for me, and I can contribute 8,000 for my wife.
Okay.
So even though she has no earned income, because I have earned income, as long as I have at least $16,000 of earned income, I can contribute the 16,000.
Okay. And then no tax deduction. What are the tax brackets? Like if you're single, how much can you do? And if you're
Right.
married?
So the government does limit how much what your income is, and it limits what you can contribute. For a single person, if your income is under $146,000, you can contribute the whole 8,000. If your income is between 146,000 and 161,000, then it kind of gets prorated. The more you make, the less you can contribute. And then after 161,000, you can't contribute anymore. For a married couple, it starts at 230,000, and below 230,000, you can make a full contribution. But from 230,000 to 240,000, once again, it's prorated. And then after 240,000, you are no longer eligible to make a contribution to the Roth IRA.
Which in some ways, I guess it makes sense. But at the same time, it's kind of like you're being penalized, right, for making money. Well, let's talk about in the event that that were to happen. This is a common question I get. A lot of people want to know, is there anything I can do when they're in a higher tax bracket? So that's where I call it the secret backdoor Roth IRA, because it's just a lot of people don't know about it. Can you kind of walk us through that concept?
Yes. The backdoor Roth IRA it's a loophole basically in the tax system that allows us to do this. And essentially what you're doing is your contribution limit, let's say, is $8,000. You're over 50, you can contribute 8,000. So what you do, and this is very important, you open up a traditional IRA, you put the 8,000 in the traditional IRA, and then as soon as it's in there, and I usually wait 30 days, 30 days later, you can then convert it to a Roth IRA. Now, what you have to be careful of is that what I do for my clients is we put it in just cash. It doesn't earn anything. So we don't have to worry about taxes. So if you put in 8, we convert 8 and it goes over and it's clean. If it starts making money, well, now you're going to have to pay taxes on any money it makes. So let's just say I put 8,000 in on month 1, and month 2 I convert it to a Roth and it's $8,020. Well, now I got to pay taxes on the $20. So it makes it a little confusing. So it's just easier to keep it clean. But that's basically how you do it. You put it in a traditional IRA. And the most important thing is then when you file your taxes, you want to use IRS Form 8606 to declare that you made a non-deductible contribution to the IRA. Because remember, you're putting it in there, but you want to let the IRS know that this money is going to be treated differently. And then you convert it to the Roth IRA, and it's tax-free from then on.
Yeah. And obviously, hopefully anyone that's earning that kind of money has a CPA and they know to file that, but you want to make sure they know. Now, one of the things I will just comment on, we do it a lot sooner than 30 days. We're trying to get that money out of there so there is no earnings on it. And most of the people I work with are. So I think the point is, regardless of whether somebody's telling you to do it right away or they're saying wait 30 days, is there some reason why you like to wait 30 days, Oscar?
I don't know. It's just I came up with that 30-day and I've stuck with it.
Okay.
No special reason.
Okay. And as long as you're doing it, I just was reviewing a situation recently where the person makes significantly over 240,000 and I saw money in a traditional IRA and I'm like, why do you have that money there? He's like, oh, that money is for my backdoor Roth. And I'm like, has that been transferred yet? And he goes, that's a really good question. I don't know. Now it is in a cash account, so he still can do it. But those are things that you got to make sure that you're covering, and you got to make sure that your CPA or your tax preparer knows so that so you're not filing it. Because I'm assuming if you don't file it, then that's probably a whole nother issue.
Yes.
Again, just be aware of it. And the key there is that you're in an account that cannot earn interest. I mean, that is absolutely critical. And I think sometimes people set it up and they're not really paying attention. And, it goes into an account, like you say, that's earning like a little bitty tiny interest. And it's like, no interest. You do not want that. Now, is there anything else about a backdoor Roth IRA that we should know about?
Well, I think probably a couple of little things. When you do a backdoor Roth, you have to, this is going to sound strange, there's a 5-year rule to Roth IRAs. And so you have to have a Roth IRA for 5 years before you can take money out without worrying about penalties. I don't want to get this confusing, but if you're under 59 and a half, this rule becomes very important. And you can always, out of a Roth IRA, you can always take out what you've put in and not have to worry about taxes or penalties. But if you take out earnings, now you have some tax issues.
If you're under 59.
If you're under 59 and a half.
Okay.
And so, but you have the 5-year rule. Now, let's just say I did 8,000 last year. Well, that has its own separate 5-year rule. And then I do another 8,000 this year. That has its own separate 5-year rule. And so every year that you're doing a conversion of any kind, or a backdoor Roth, it's got to have a 5-year rule. So just kind of keep that in the back of your mind.
And just to clarify, the 5-year rule is how long you can take the principal out, but you can't take the earnings out.
Correct.
Okay. Gotcha. That's good.
And so as long as you're keeping track. So if you're over 59 and a half, there's still a 5-year rule, but it's really not as big a deal because you can pull out what you put in and take the earnings later. But if you're under 59 and a half, it does become, you got to be careful. I have had a couple of clients that needed money and I had to say, this is how much you can take out. Anything more than that, and you're going to get penalized and taxed.
I think that's a good point right there, though, too, of the fact that you've got enough money in personal assets. Because, I love annuities. I love retirement accounts. I love pensions. I love all that. But the reality of it is that with that, some complexity, and you don't have the ability of just basically taking the money out whenever you feel like it. You may be able to, depending, but you may not. And that's why it's so important that you've got those personal assets that are in, they're owned by you or your trust, and that you have easy access to them. And I think that's something sometimes people get so caught up in investing something or putting something in, say a Roth or an IRA or a qualified account, that they don't realize they really need to ideally be balancing it. I like to see like a 50-50 mix. But I even look at like our situation, because our retirement has done so well because we've invested it much more growth oriented. I mean, we are going to have such a tax problem when we have to start taking it. And I know, you say, oh, that's such a problem, but it's hard to really be tax efficient when you're forced to take an extra 100,000 or whatever amount it is out of something like that. And so I don't know if you have anything to add about that.
Yeah, well, it is important to think about moving forward, because If you have to take out, and I'll just give you an example, one of my clients, he has to take out so much out of his retirement every year. Not only does it put him in a new tax bracket, but it also causes his Medicare to go up significantly. I mean,
Yes.
and I'm not talking $100. I'm talking several $100s a month for both him and his wife. So those are the
Yes.
repercussions of having too much money in a traditional IRA of some type.
It is. And it's like what, $300 or $400 more a month, isn't it?
Yes.
Per
Yes.
person.
Per
I mean, I
person.
didn't even know that until I was like, wow, it just adds up. And so again, it's one of the things of being able to look at kind of the bigger picture and make sure that you're making decisions that work for you. But I love Secret Backdoor Roth IRA, and I encourage you to look at your situation and see if it's applicable. Now, if you have questions, I encourage you to go to themillionaireinsider.com/support-request, or you can go to themillionaireinsider.com/SR and make a note that you have questions and you can talk to Oscar. He's more than willing to talk to you and just look at your situation before you make some decisions. So again, I really encourage you to take him up on this opportunity, themillionaireinsider.com/SR. There you have it. Now let's just kind of recap. The first thing is making sure you don't have all your money in qualified accounts. You've got some in personal accounts that are after tax or that are taxed at capital gain rates, just so you have the flexibility of where you take your money. We discussed the fact that if you want to put money in a traditional IRA or a Roth IRA and you're under 50, you can do 7,000. If you're over 50, 8,000. Now that number is going to change. It continues to change, and it's imperative that before you do anything, you look at what the current rules are. We talked about the fact that I just read an article, just came out last week, talking about the fact that 401k Roths were taxable. And I thought, gosh, I thought they weren't. So you've got to be careful and you got to know where your sources are. This was a reputable firm. And so I'm actually really interested about looking back at that. But I think it's something that we all have to be paying attention to make sure that we know the numbers and that we know the numbers when you're, real time doing it. Because if somebody's doing it, you've got to make sure that you are following those rules and you don't get yourself into a pickle where you think you have to take it out and you really don't. And then we talked about the contributions to Roth IRAs as far as if you're single and you earn less than 146, you can deduct the full amount. It starts phasing out to 161. After that, you can't. The only opportunity is to do a backdoor Roth IRA. Married couples is below 230,000. It phases out at 240,000. So a backdoor Roth IRA can be advantageous for those of us that have higher incomes and that want to still put more money away. What's nice about the Roth IRA compared to the traditional IRA is the traditional IRA, you get a tax deduction, it grows tax deferred, but then you have to pay taxes on it. And typically, some of us believe tax rates are going to go up, so you're going to have to pay more. Whereas with a Roth IRA, a backdoor Roth, or even a Roth, regular Roth, which they both end up being the same, but one gets there a little bit differently, is that it's tax-free when you take it out. Is there anything else you want to add just to give people a recap, Oscar?
Yes, just if you fund both of them, the traditional and the Roth, at the other end, you have more flexibility. So whatever taxes are, you can have a little more control over your taxes because tax rates do go up and down. But generally speaking, if we happen to be in a higher tax rate, maybe you take more out of your Roth that year and a little less out of the traditional. So it just gives you a little more control over your taxes. And that's why it's important to have both pots.
Yeah, I think that's huge. Now, one thing you've got to do is you got to make sure you're meeting your required minimum distribution. So that's not flexible. But once you've done that, and let's say you need more money, then you have the flexibility. And I love that. Oh, this has been so good. I just love backdoor Roth IRAs. I just think they're so great. And I think so many people don't know about them.
Right.
So let's talk about the ease of doing this, because I think one of the objections people have is it's such a hassle. You got to set up a traditional IRA and then you got to fund it and then you got to transfer it. Do you have some tips on making it easier for people?
Well, what I do with a lot of my clients is because it becomes a routine thing every year, we just kind of put it on autopilot. So they make their contribution every year and they could do it any way they want, but we do the contribution every year and then I move it. I do it automatically for them. So it's really hassle-free for my clients. I'm doing all the paperwork ahead of time. And the only thing I do that makes it easy is I always leave a couple of dollars in the old traditional IRA account so we don't have to close it or reopen it or do anything. So we just leave a couple of dollars in there. It stays open and it makes it so much easier to do that on an annual basis.
Yeah. And it's in an account that is not earning any income of any sort.
Correct.
No income. All right. Well, this has been great. So I want to thank you so much for joining us. And thank you, Oscar. You're such a wealth of information.
Thank you for having me.
And I encourage you to go to themillionaireinsider.com/SR. If you have any questions or you want to consult with Oscar, he is a wealth of information. So again, thank you so much for joining me, and I'll look forward to seeing you on our next episode. If you love the content of this podcast, please follow and subscribe to our channel so you get notified of episodes, and also give us a 5-star review and share a comment. We really appreciate it. Congratulations on taking another step to create a financially free life you love. If you're not sure about your financial future or that it's in order, or you are ready to stop worrying about money, or possibly the fear of becoming a bag lady, ending up broke in retirement, or you simply are ready to know your financial house is in order so that you can have a bright financial future, please go to themillionaireinsider.com/NSF. And that doesn't stand for non-sufficient funds. It stands for Next Step Finance. It's the next best step of what you need to do so you can avoid an NSF notice in your future. Again, themillionaireinsider.com/NSF. The number of women who were not broke or poor while working or married is staggering. The entire mission of the Wealth Inside and Out podcast is to ensure you have the information for you, your family, your friends, anyone who's willing to listen to it and apply it so that you can create a financially free life you love. Again, themillionaireinsider.com/NSF. Until our next episode, take one action that will help you create a financially free life you love. I'm Annette Ba'u, your host. All international copyrights are reserved. Bye for now.